Hello everybody, Jackson here with the Wealth Squad. Today we'll be talking about something very important. We'll be talking about selling covered calls. And this is essentially owning 100 shares of a liquid stock. The stock has to be traded, at least, a couple million times a day. Now this stock has to be liquid because you want your options to be liquid as well, so you could get in and get out. But anyways, you want to buy 100 shares minimum. That's the least you need, and it has to be 100 because that's how much you have to own in order to sell a contract. And then you sell a future price for this stock. Now it sounds complicated, but it's truly not. We're going to get into it today. But by selling that future price, you generate a premium upfront, and you get that chance to sell when it comes down later in the timeline for your position. So let's get into this. Let's say you have 100 shares of PayPal, right? You buy 100 shares. We're gonna get this notepad out here. Your 100 shares is a $10,000 investment. 100 shares of PayPal, right? Now, a couple things could happen. It could go up or it could go down. That's it. But first, we have to look at the options, right? We are bullish on PayPal. We buy 100 shares, but we learned about this cool new way to generate income while we hold our long-term positions. Let's look into it. This is an option chain, which essentially tells us all about these options that are expiring on June 17th, 2022. In the blue is in the money, which means it's in that price range. You can see 158, and 100 is in the money because it's under the current stock price. Now, in the non-blue is over or not in the money, which means you're betting that it will hit that price. So for someone who thinks PayPal will hit $105, they're going to buy these for $6.15. And then when it does hit $105, let's say it's 110 on June 17th, they could buy 100 shares for 105, even if it's 110. They save that money. Something like that for any of these options, right? They could buy 28-cent contracts for 155 calls. Let's say it goes up, these calls will be worth more. They may not have to execute them, but they could still ride the wave up. So what we are going to be doing is we're just going to choose this random day, June 17th, couple months out, 2 to be exact. And we think PayPal will at least be 110 by then, right? If not 120, but we're going to be betting on 110. So we're buying 10 shares for $100 a pop. We're buying 100 shares for $100 a pop, $10,000 investment. So what we're going to do is sell this call. We're going to sell it before we buy it. And that's a covered call. We're selling a covered call. By doing this, we are signing a contract essentially that we will be selling 100 shares of PayPal at 110 if they wish. Let's say PayPal is 120 by then. Okay, PayPal is 120. We can only sell for 110 because we agreed to it. But let's say PayPal is 105. It's a different story. We don't have to sell it all, but we collect this premium. As soon as we sell this call option, we collect this. So that's $4.45, but you times that by 100, $445. So let's get into this. 100 shares of PayPal at $100. You have a $10,000 investment. Let's say it's June 17th, and PayPal is 115. Too bad. You agreed to sell at 110. You wrote a contract. You agreed to the contract to sell at 110. So you sell all of your 100 shares at 110. You make $1,000 in capital gains. And you agreed to that contract premium of $445. So as soon as you sell that contract, you get that $445. That's up front. The $1,000 in capital gains is later. So you make $1,445. Okay. Now let's say it hits 105. This is where it becomes smart, because if PayPal hit 115, you would make 1,500 from pure capital gains. But we only made a little. We made a little less. But it's the risk that is important here. If it hits 105, you'd make $500 normally, right? 100 to 105, you own 100 shares. But in this case, you make capital gains of $500, sure. plus the contract premium because it did not go through. Even if it did go through, you still collected that premium because you sell it right off the bat. You make that $445. Now, I'm sorry, you make the $445 plus the $500, you're up $945 compared to if you just own the shares outright, which is $500. Okay, now let's say it goes down. You're still a long-term investor in PayPal. You think it'll go up eventually quite a bit. Let's say it goes down. You still have your shares, right? In both of these scenarios, you still have your shares. You do not sell. Only when it's above the contract price or the contract price, you sell. If it's below, you do not. So let's say it hits 90. You still have all your shares. So your capital gains turns into capital losses. Your $100 stock turns into 90. Your $10,000 investment turns into $9,000. You lose $1,000, but you still collect that contract premium. So that's his risk aversion. Now you're only down to $555 because you lose $1,000 and you make that $445 contract premium. This is why selling covered calls makes so much sense. You have 100 shares of something, it goes down, you still make that $445 that you would not if you did not sell the covered call. If it goes up a little bit but not all the way, you still make those capital gains plus the contract premium. Now the only bad part is you limit your upside. PayPal next day could agree that it was sold to Tesla for $150, right? But you only made $110 plus the contract premium. When you could make $5,000, you only made $1,445. But you have to think about it in the sense of risk. If it goes down, you still make that $445. If it goes up, you still make that $445. If it doesn't move at all, you still make that $445. And you only lose money if it goes down. There's no real way to lose money besides the stock price going down, which is normal for any stock investor, right? You only lose money if it goes down, but a normal investor does not make money either way. You make more selling a covered call if it goes down. If it stays around the same, you only make less if it goes up, but you still make something. So I hope this makes sense. You are ruining your chances of making more money by not doing this. But the key is to do it on something you actually believe in. PayPal, for example, has gone from 300 to 100, down 66 or so % in a year, less than a year. So what does this tell you? That either one, it's undervalued, two, something's wrong internally within the company, or three, you're dumb enough not to buy it. Right? You're dumb enough not to buy it because it's gone down this much and it was so high before. You have to actually trust the company and invest in it long term in order to rightfully sell a covered call, because if it goes down, you want to have that premium that you collected to buy more shares to average your price down. A good thing to do this if you have money is with index funds. So QQQ is the NASDAQ index fund. So you're going to have $34,000 you need to buy a contract and sell a contract. This way it is easier, more liquidity, and you have less company-wide risk, right? PayPal itself, the CEO could die or something and the stock falls 20%. But if you invest in this and the CEO of PayPal dies, nothing happens. 5 CEOs could die, nothing could happen, because it's a general wide index fund of hundreds of companies. So I hope this makes sense. I hope you make some money from this. If you don't make some money from this, I'll be ashamed, because this is amazing knowledge, and if you're not taking advantage of it, then I'm not sure what to tell you. Please let me know if this helps you in any way. We talked more about this on our Instagram post that we posted today. So if you need some more clarification, see that. But anyways, thanks for watching, and until Wednesday, our next video. Bye.